Welcome back to the deep dive. Today we have a pretty clear mission. We're stripping away all the confusing noise, the hype, and the thousands of conflicting opinions about money.
Right.
To get straight to the blueprints of genuine financial security, we've taken the synthesized wisdom of some true ultra investors. I'm talking Ray Dalio, Jack Bogle, Carl Icahn, and we've mapped out a path you can actually use.
And this dive promises something beyond just textbook knowledge.
Yeah.
We're synthesizing strategies that have historically been pretty exclusive to the wealthiest class.
Things you wouldn't normally see.
Exactly. Tactics used by leaders who manage literally trillions in assets, like Mary Callahan Erdos at JP Morgan Asset Management. The material organizes all these insights into 7 core principles.
That's the focus.
It's strategy, psychology, and the absolute elimination of financial inertia.
That really is the core challenge, isn't it?
It is.
As an individual, how do you find a single reliable path through what the sources call this high-tech, high-risk maze of choices?
It's overwhelming.
Totally. Everyone out there has an opinion. They've all got a stock tip. They're selling some kind of system.
Right.
But it's so rare that they offer advice that genuinely helps you build security without taking on some crazy, unnecessary risk.
Well, to solve the modern dilemma, we first have to understand the modern context.
Okay.
The research shows that retirement, as this universal life stage, it's a relatively new concept.
It only really worked for a generation or two.
That's right. We currently rely on this do-it-yourself pension system, the 401k, and the fierce critique from economists like Teresa Ghilarducci is that this entire experiment has, fundamentally failed the average worker.
And the reason for that failure isn't just lack of savings, it's the expectation. It demands that non-experts, people like you and me, achieve the results of professional money managers.
Which is an impossible ask.
And when you factor in the longevity challenge, the math just, it breaks down completely. If you retire at 65 today, you're likely to live past 85.
Or even 95.
So you're financing a 20 to 30-year retirement.
Exactly. And it's mathematically unrealistic to fund 3 decades of retirement by working for 3 decades and only setting aside 10% of your income.
Right.
It just doesn't add up.
Right.
And this is where the psychology of failure really kicks in. We fail even when we understand the logic because of our cognitive limitations.
The fascinating work from behavioral economists like Dan O'Reilly shows that when decisions become overwhelming or complex, humans don't seek out the perfect solution.
No, we do.
We default to sticking with the status quo. We just freeze.
And that freeze response is what we call inertia.
And it is the single most destructive force in financial planning.
You see this dynamic most vividly in really simple choices.
Yeah.
We found a great example with organ donation forms.
Okay, tell me about that.
In Denmark, you have to actively check a box to participate.
So it's an opt-in.
An opt-in, and the donation rates are low. But in Sweden, where the default is participation and you have to check a box not to participate,
It's an opt-out.
the rates just skyrocket. All because of that simple shift in the default setting. Inertia is just that powerful.
Wow. And that tiny piece of friction explains why only about a third of American workers even use the retirement plans available to them.
It just feels like too much work.
And on top of that, we have to grapple with loss aversion.
Yeah, this is a big one. We are deeply wired to hate losing something more than we enjoy gaining it.
I've heard about this.
The research illustrated this using a study where monkeys were given 2 apples and then had one taken away.
And what happened?
The monkey became, as the researchers put it, angry as hell.
Despite still having 1 apple left.
Exactly. That visceral pain of loss is immediate, and it's powerful.
So if saving means giving up a dinner out or a purchase today, it feels like a loss.
A direct, immediate loss.
And even though it's a massive gift to your future self, we avoid that perceived pain, and that's what keeps us stuck.
Precisely.
Okay, let's unpack this then. Let's look at the 2 core accelerators that can shift us out of that inertia and onto the path of freedom.
The first, and maybe the most foundational, is the power of compounding.
The 8th wonder of the world.
Warren Buffett famously credits much of his fortune to compound interest. And the core truth here is that for the vast majority of people, earned income alone will never bridge the gap.
It can't.
It just cannot compete with the exponential growth of compounding.
This is where we need to spend some time on the actual calculation because it's about consistent momentum. It's not about waiting for some huge windfall.
Right. It's about starting now with what you have.
Okay, so let's say you save just $40 a week. That's what, $2,080 a year?
A manageable amount for many people.
If you consistently invest that money and you earn an 8% compounded return over 40 years, that small regular commitment, it balloons to over $581,000.
581,944 to be exact.
That is the magic of compounding, turning small, consistent efforts into more than $500,000.
And that leads us directly to the second accelerator, which is leveraging your lifestyle as rocket fuel.
So not just saving, but how you live.
Right. This is where mindful savings comes into play, identifying and eliminating those recurring, often subconscious expenditures that just drain your future.
We found a perfect, vivid consumption trap in the sources for this one.
Oh, yeah.
Bottled water.
Ah, of course.
Let's take a couple spending $150 a month on premium bottled water. That's $1,800 a year.
Seems small, right? In the grand scheme of things.
It does. But if that $1,800 were invested annually at 8% compounded over 40 years, that couple is effectively forfeiting.
I'm almost afraid to hear the number.
Over $503,000 of future wealth.
Wow.
Just for the convenience of drinking smart water instead of filtering their tap.
That $500,000 decision really highlights the power of reducing unnecessary friction.
Yeah.
But to truly accelerate, we also have to address the earning component.
So making more money.
The wisdom shared by great mentors, like Jim Rohn, is really clear on this. To have more, you must first become more.
Meaning?
You're paid for the value you bring to the marketplace, not the time you spend working. So investing in your own competence, your own value, that's the fastest way to earn more.
And this is where the more radical shifts come into focus.
Mm-hmm.
One of the most aggressive, but also fastest ways to accelerate your financial freedom is changing your zip code.
A big move, literally.
The sources suggest that moving to a less expensive city or a tax-friendly state can instantly increase your disposable income and therefore your savings rate by 10 to 30%.
It's a profound shift because it's a one-time decision that delivers compounding benefits every single month after that.
Right. Why wait 30 years to move to a warmer, less expensive climate in retirement?
When moving today could shave years, maybe decades off your working life and just massively accelerate your wealth through cost arbitrage.
Exactly. So let's look at the investment landscape itself now, which some sources frame as a game, but a rigged one.
A rigged game is a good way to put it. Steve Wynn, the billionaire casino mogul, called the mutual fund companies the ultimate casino.
And he should know.
He acknowledges that the house always has the edge. And he's right. But here's the crucial difference. Unlike a physical casino, where a lucky high roller might walk away with millions, the mutual fund companies are guaranteed revenue through fees, whether you, the investor, win or lose. They have a stacked deck. It guarantees them a perpetual profit stream.
Which brings us directly to the core problem. The fundamental conflict of interest that's just inherent in the financial industry. Ray Dalio emphasizes that the typical money manager you talk to is not playing in the big game.
What does he mean by that?
If they truly had superior skills, they'd be managing billions for themselves and their closest partners, not selling standard products to the retail market.
And this is why the advice is so simple. You have to follow the money.
Okay.
And you must understand the difference between a broker and a fiduciary. The research defines a fiduciary as the gold standard.
What does that mean in practice?
It means a professional who is legally bound to remove all potential conflicts of interest and put your financial needs above their own profit. This is the exact opposite of the standard broker model.
Which only has to recommend what's suitable.
A very, very different standard.
And the cost of ignoring this distinction is, well, it's staggering, thanks to what Jack Bogle termed the tyranny of fees. Bogle calculated the long-term impact of high-cost active management. It often costs the average investor about 2% annually once you factor in all the hidden costs.
All in, yeah. The expense ratios, transaction costs, advisory fees.
And think about Bogle's famous comparison over 50 years, assuming a 7% market return. A low-cost index fund, which might charge 0.1%, it turns $1 into $30.
Okay, a 30-fold return. Not bad.
But that high-cost active fund, because of that cumulative 2% fee, only turns the same $1 into about $10.
So you lose 2/3 of your potential return.
Exactly. You put up 100% of the cash, you took 100% of the risk, but the fees took 2/3 of the reward.
If the difference between $30 and $10 is just 2% in fees, Why do people still pay for active managers?
It's the search for the elusive genius, isn't it?
Bogle had a great illustration for this.
The gorillas?
The gorillas. He suggested putting 1,024 gorillas in a gym and teaching them each to flip a coin.
Okay.
One gorilla will inevitably flip heads 10 times in a row. It's just statistics.
And what do we call him?
In the fun business, we call him a genius. But it's entirely luck.
So active management success over the long term is overwhelmingly governed by luck, not skill.
That's what the data says.
That dramatically shifts the calculation, doesn't it?
It does.
So once we accept the market is largely efficient and subject to luck, how do the truly elite investors structure their strategy?
They focus on one thing: asymmetric risk-reward.
Okay, break that down for me.
Yes. This is the strategy of seeking opportunities where the potential upside is dramatically bigger than the downside. It's less about picking winners and more about protecting your principal.
Protecting what you have.
Right. Paul Tudor Jones, one of the greatest macro traders of all time, has a strict rule.
What's the rule?
He never makes an investment unless he can potentially get a return of at least $5 for every $1 he risks.
So a 5-to-1 ratio.
At a minimum, if the potential loss is $10,000, the potential gain must be at least $50,000. You define the relationship first.
And you see this principle in action with some of those legendary bets, like Kyle Bass predicting the collapse of the U.S. housing market.
A perfect example. He structured his trade so he was risking just 3 cents to make $1, or, more accurately, risking a small percentage to achieve hundredfold returns.
That's the definition of an asymmetric opportunity, a small risk with a massive potential payoff.
Exactly.
But if we connect this to the bigger picture, why bother with all this intense optimization?
Well, the sources stress that investing must meet our human emotional needs, particularly the need for certainty and comfort.
So it's not just about the numbers on a spreadsheet.
Not at all. If pursuing a mathematically perfect asset allocation, one that maximizes theoretical returns, causes so much stress and discomfort that it makes your daily life miserable,
Then what's the point?
it has failed its purpose. If holding treasury bills, even with a low return, allows you to sleep well at night, that emotional metric makes it the best answer for you.
So the ultimate purpose of investing is financial freedom, but not at the expense of psychological peace.
You've got it. The goal is not just to maximize net worth.
Which brings us back to the psychological game. It's just as critical as the strategy.
Absolutely.
The sources identify 3 key steps to creating a massive breakthrough in any area of life, including your finances. First, change your state, your mental and emotional perspective.
Okay.
Second, change your story, the limiting beliefs you hold.
And third,
And third, then you find the right strategy.
that order is important. State, story, then strategy.
It is.
And changing the story is just immensely powerful because your belief system is actively costing you money.
Oh, for sure. Consider the couple we reviewed, where the wife held this deeply limiting story that money is evil.
And that story translated into complete inaction around it.
Total inaction. But once they worked to divorce themselves from that belief, they finally took action. They dumped their high-cost mutual funds and transferred their assets to low-cost alternatives.
And the result was tangible, I assume.
Incredibly. That simple shift in strategy, which was only enabled by that psychological breakthrough, resulted in an extra $150,000 to $250,000 in their pockets over their investment lifetime.
Just from changing a story.
The stories we tell ourselves determine the financial strategies we implement.
And when we look at the 6 basic human needs, certainty, uncertainty, significance, connection, growth, and contribution, we realize money is just a tool.
A tool to meet those needs.
Right. Financial mastery isn't about the size of the number. It's about aligning the tool with the ultimate goal.
And the ultimate expression of that mastery is found in contribution, in giving back.
It's a powerful one.
We found the incredible example of Chuck Feeney, who gave away nearly his entire $7.5 billion fortune during his lifetime.
And by all accounts, he achieved profound personal joy despite living incredibly simply.
Flew coach, wore a plastic watch.
And the psychological benefit of giving is, surprisingly, a powerful wealth accelerator
How so?
because it shifts your internal state. The finding that volunteering just once a week yields improvements to your well-being equivalent to increasing your salary from $20,000 to $75,000.
That's remarkable.
It is. Giving even when you feel you have little teaches your brain that there is more than enough.
It pulls you out of a mindset of scarcity and into one of abundance.
Successfully,
Yeah.
yes.
So, to summarize the synthesis here, financial mastery requires identifying and applying those key strategies, maximizing compounding, reducing fees, seeking asymmetric risk,
While also rigorously eliminating the psychological traps.
the inertia, the limiting personal stories. You have to tackle both.
For concrete next steps, the sources provide two immediate, powerful recommendations.
Okay, let's hear them.
First, for family protection, explore establishing a simple, living, revocable trust.
Why is that so important?
It's essential because it means your core assets skip the costly, lengthy, and very public court process known as probate. It acts like a private roadmap for your finances. And free templates are widely available online.
Okay, good to know. And the second one?
Second, especially as you approach retirement, look into guaranteed lifetime income plans, specifically fixed annuities.
In simple terms, what is that?
It's about creating a paycheck you literally can't outlive. It provides a bedrock of financial certainty that addresses that fundamental human need for comfort and security.
A personal pension, in a way.
That's a great way to think about it.
This brings us to our final provocative thought. Ray Kurzweil, Peter Diamandis, and other futurists consistently point out that technology is accelerating faster than ever, making the future vastly better and cheaper.
We are seeing absolutely radical breakthroughs.
From regenerative medicine, where stem cell spray guns can heal severe burns in 3 days, to 3D printing democratizing manufacturing.
The pace of change is just astonishing.
So if technological breakthroughs are accelerating this quickly and the cost of a high quality of life is potentially decreasing over time, what limiting belief about future cost and lifespan should you divorce yourself from today to ensure your financial plan isn't based on outdated fears?